Hey friend, thanks for joining me today on the Lawyer Millionaire podcast, where we help law firm owners build profitable practices and personal wealth.
Welcome to the Lawyer Millionaire podcast, the show where law firm owners learn to build wealth, scale their firms, and design the life of freedom they deserve. Hosted by Darren Wurz, business and wealth advisor for law firm owners and author of The Lawyer Millionaire, this podcast delivers the strategies and inspiration you need to break free from the grind and become the financial success you envision. Let's dive in.
Today we're talking about financial forecasting. You know, a plaintiff's firm can have millions locked in cases and have no idea when the next dollar is arriving. Today we're talking about how to fix that problem exactly. In last week's episode, we introduced the idea of profit forecasting and talked about a profit forecast framework that works for most businesses and most law firms. But you know, PI and contingency type firms are a different animal entirely. And so today I'm talking to you, my contingency lawyers, PI, mass torts, plaintiff's work. Your business is a different animal entirely. In the hourly model, you work, you bill, you get paid in 30 to 60 days, but you front hundreds of thousands of dollars in costs. You wait 2 to 3 years to see a dime. Your income is lumpy, it's delayed, it's uncertain. Contingency revenue isn't unpredictable, though, and today I'll show you how exactly you can predict it. It's differently predictable. You're not forecasting a timesheet. You're not forecasting recurring revenue coming in on a fixed schedule. You're forecasting a portfolio. Value times probability times timing. And here's where my thinking and my training as an investment advisor can really, really help you. There's a unique magic formula that I'll show you. This is the next step, by the way, in our Profit on Purpose book tour this year. This quarter, we're diving into Simple Numbers and Simple Numbers 2.0. We're talking about the science of profit and making profit a science in your business, not something that you guess at, something that you can know for certain, something that you can design mathematically and scientifically, not bury your head in the sand and just hope more cases come in the door. You've got to have a system. And what we're talking about this quarter is how you can make profit a very specific and exact science in your business. You can be intentional with your profit even when you have wave-like, tsunami-like revenue. And this is how you do it. By the way, all of this comes from what we're talking about in our community. So if you're not yet a member of the Lawyer Millionaire community, well, what are you waiting for? Head on over to community.lawyermillionaire.com and join us. We have over 120 law firm owners in the group. We have regular events where we're breaking down these concepts in even more detail. Lots of resources waiting for you there. Well, why does this matter so much more for you than the hourly firm down the street? Well, I already mentioned some of that, but the true cost of flying blind is really, truly higher for you. Most contingency firms don't know the total value of their caseload. They can't predict when or if revenue gets realized. They're just guessing at when things come in and flying blind and just seeing what happens. And that's a big problem because you take on an enormous amount of financial risk. And things have only gotten worse with things like tort reform and clogged courts. What used to take 6 to 12 months could now take 18 to 36 months. An extra year of waiting for cases to settle or get litigated could add tens of thousands of dollars in case costs per case. For you, forecasting isn't just a nice to have. It is survival, and it is the foundation of growth. You need to do it. You need to forecast. And I know you've been putting it off, but let me illustrate the impact here. Let's say you have a bunch of cases that settle together. You get a big check and your account looks rich. So you take a huge distribution. You fly to Vegas for the weekend. You have a steak dinner at the Mirage, and things are great. And then things are terrible. Because all that cash wasn't all yours. You owed some of it back to live cases. You needed to keep some to invest in future cases. You owed some to taxes and Uncle Sam. And you owed some to your reserve, and probably case costs as well that you need to pay off. Take that distribution on the high, and 3 months later, you'll be borrowing on the line of credit. The settlement felt like a windfall, but it should have been a planned event. And the quiet killer here really is case cost advances. Money fronted across dozens or hundreds of matters can silently eat into your cash. Firms can have hundreds of thousands to millions of dollars locked up in case costs. The winners here aren't the ones with the biggest verdicts. They are the ones that can see the cash and the pipeline clearly enough to fund the next great case. Okay, so let's build the system. And the centerpiece for contingency firm is what we call the pipeline report or case inventory report. Here's how it works. For every active matter, you're going to want to capture a handful of fields right inside your case management system. The matter and the case type, the expected resolution or settlement date, the expected gross settlement amount, your contingency fee percentage, and the probability of winning or settling. Now, let's talk about how you determine the case value, expected case value. Okay, because you probably have a case value, right? You've gone through the case, you've looked at the medical records, you've looked at the damage, you've seen what happens, you've seen cases like this before. You know what this case could be worth. We're not talking about that. We need to first determine the expected value of each case, the expected value. Not the value, the expected value. Not what you're hoping to settle for, not what you assess the damages to be, but what you expect to actually receive when you factor in the probability of winning or losing. This is similar to an expected rate of return calculation in finance. So I can determine the expected rate of return for a mutual fund, a stock, etc., by looking at the distribution of potential of returns, historical returns, and applying a probability to each of those to arrive at what I expect the return to be each and every year. It's pretty cool. Now, we can do the exact same thing to your personal injury contingency fee cases. You're going to want to know a few things. Number one, you're going to want to know your probability of winning. What is, historically, or based on this case type, based on your record and based on this type of a case, what is your probability of winning? Let's say that's 80%. You have an 80% probability of winning this case. Then let's determine your potential verdict or potential settlement. Let's stick with settlement. Your potential settlement amount. What is the estimated payout if you win, i.e. $500,000? Let's say your probability of winning is 80%. And your estimated payout is $500,000. Well, to determine the expected value of this case based on probability, you would simply multiply your probability of winning times the potential settlement to receive your expected value. 80% times 500,000, your expected value for this case is $400,000. So we're going to use that value in your forecast. When we forecast how much money's coming in, this case is worth $400,000. We're going to forecast $400,000 coming in from this case. Even though we think it could get us $500,000, we're going to use that expected value. And we're going to use that by using that same formula across all of your cases. You're going to really hone in pretty closely on what your actual, cash in and profitability will end up being. Your forecast is going to be pretty good. Now we need to apply one more filter to this, because some cases settle and some cases are going to go to litigation. Well, before we do that, we need to multiply your fee percentage to get the expected fee from that case. But okay, now the timeline. Now you know that most cases probably settle for most people and probably for you too. So you need to figure out what is that percentage. What percentage of your cases actually settle? Let's say that's 75% or 80%. Okay. Now, once we have our expected value and we have our expected fee, right? So with 400,000, we've multiplied by our, fee of 40%, and so we're going to get $160,000 from this case. We're going to reduce that again, okay? Because we're going to multiply by another percentage, which is my probability that this case actually settles and doesn't go to litigation. So I'm going to multiply that by that percentage. Let's say my percentage of cases that settle and don't go to litigation, my pre-lit percentage is 80%. And so now I can apply my actual time frame. What's my average time to settle a case? Let's say that's 12 months. So 80% times my $160,000, I'm going to put that coming into my forecast. It's coming in 12 months from now. Okay, so that's how you do it. And you're going to have two pipelines because some of those cases won't settle and some of those cases will actually go to litigation. And so you'll have two pipelines. You'll have a pre-lit pipeline and you have a litigation pipeline. The 20% that goes to litigation, that's not lost revenue. It's going to be deferred and it's going to be repriced. It now resolves on a different timeline, a litigation timeline. So you're going to look at your statistics based on, for those cases that go to litigation, how long does it take for those to resolve? What is the typical settlement value for those types of cases? Usually it's a higher settlement amount, but it's going to be against much higher case costs, and it's going to have its own individual particular win rate. So you'll have a separate layer to your forecast for that second bucket of cases in litigation. Each bucket carries its own settlement value, cycle time, probability, and case cost assumptions. Do that for every matter, and then bucket those expected fees by month. If you're doing this for each matter, you're going to have a guess, an estimate as to how much money, based on your expected value calculation, based on your pre-lit percentage, how much money is coming in this month, next month, etc. You can bucket the fees by months or by quarters, up to you, based on when you expect them to land. And just like that, my friend, the impossible becomes a forecast. You can look at your calendar or look at your forecast and say, based on our actual caseload and actual win rates, here's roughly what's coming in May, here's June, etc., etc. That's not a fantasy, that's your portfolio, weighted by reality. You've got to think about your case inventory as a portfolio, almost like a portfolio of stocks with an expected rate of return. Now, one of the things that we know the expected rate of return is going to be wrong. That's why we're diversified. Think about it like the stock market, right? The average rate of return for the stock market is, 10% a year. Now we know that's going to be wrong. Every year it's going to be wrong. But over the long term, it's going to be roughly correct. And the same thing is going to happen here. Now, here's a practical move that keeps this from becoming a full-time job. For your big cases, you're going to get really specific. And, this could be a little different for those because they're going to need some higher attention. But if you've got hundreds of smaller cases, don't try to maintain, exact, variables and dates for each individual one. Instead, assume that each matter is going to resolve on your standard interval after intake, whether that's 12 months, 13 months, 14 months, etc. Same math, less upkeep. You're going to get a reliable forecast that you can maintain over time. For the big cases that are unique, that are unicorns, they're going to require their own math, their own specific figuring. But for your average run-of-the-mill case that comes in, you can just simply apply your averages to that case, throw it into your forecast. Now, you're going to take that revenue forecast and turn it into a profit forecast. Layer in everything else, operating expenses, labor costs, and the expected increase in case costs, because that's real expenses. You can do this as a cash flow forecast and a profit forecast. Cash flow forecast is going to show you cash in the bank, cash that's coming in, and cash that's going out. Profit forecast is going to have all the real expenses that are realized. Don't include case costs. I'll explain case costs in a minute. Now, you'd be able to see then month by month and quarter by quarter whether you actually have cash on hand and whether or not you'll actually be profitable. Forecast out over the next several months or quarters and update every week. Once your case management is set up with those fields and you've got the system running, refreshing it only takes a few minutes a week. And you'll know exactly where you're headed. Now, I want to go a little bit deeper on a couple of things here. First, forecast the whole funnel, not just your open cases. Your open cases are only part of the story. The cases that fund you 2 years from now are the leads you haven't signed yet. So model the funnel. Leads to signed cases, to fees, to cash. Apply those, apply your percentages, right? And be honest about conversion. Some industry estimates put intake to retain conversion as low as 5%. If that's true for you, then landing 10 new cases this year might take 200 qualified leads. When you know that ratio, your marketing spend stops being a guess and becomes a simple dial that you can dial up or dial down. One more metric that you should watch here, and that is cycle time. Cycle time is the median number of days from signing a case to resolving it. Firms with disciplined operations often run pre-lit cases in the 200 to 270 day range. Why does it matter? Because the faster your cases cycle, the faster your capital comes back, and the more volume you can carry. Cycle time is important. And it's the number you're going to use to determine when cases are coming in for you. Second, handle your case costs correctly. And let's talk about case costs. When you advance hard case costs, experts, filing fees, litigation expenses, the IRS generally treats those as loans to your client, not as deductible business expenses in the moment. That means they sit on your balance sheet as receivables, and you only get that deduction when your case resolves and the case costs are recovered, or when you write them off because the case was lost. Your ordinary soft overhead, rent, staff, utilities, that's deductible as you incur it. But the case advances are a different beast. So 2 things. 1, in your forecast, model the growing balance of case costs as a real use of cash, but not as an expense that reduces profit. Instead, apply an average case cost metric to each case when you calculate its expected value. That will help match up the revenue and expenses on your timeline. And 2, review your aged advances regularly, write off the dead ones on dead cases. If you treat advances as expenses, you'll misstate your profit and tax position. Third, discipline your distributions and reserves. This is where forecasting protects you from yourself. Here's the rule. Distribute actual cash, never paper profit. If you expect fees are high but the cash hasn't landed, wait or take a partial draw. You don't want to pay out money you don't have. And you're going to need to keep a bigger cushion than the hourly firm would. The general guidance is 2 months of operating expenses in reserves. For a contingency firm with volatility, you should probably aim for somewhere around 6 months or higher. Schedule your distributions and refresh your forecast before every single one. And here's a smart tax move when several big cases land in the same year. Structured attorney fee deferrals let you spread out large one-time fees across multiple years. There are a lot of great tools for structured fee arrangements. One of them that we like is structures.com because it's a market-based structured fee arrangement. But there are many others out there, something that you should think about exploring. If you've never explored that before, happy to talk with you about that. Those can soften the tax hit and turn one giant lumpy payday into something more even and spread out. And finally, use financing as a forecasting lever, not a panic button. Because so much of your capital is locked in cases, partner equity shouldn't be the only fuel. Case cost financing, litigation funding, a working capital line of credit. Holy crap, if you're running a personal injury firm and you don't have a line of credit, what the hell are you doing? You need something like that to bridge the gap between when you spend and when you collect. The key is to build the repayment into your forecast so that it's a planned tool, not a desperate scramble. Now, once you've got all this in place, you will be able to breathe a sigh of relief. You'll be able to look at your partner or your employees and say with real confidence, we can afford to take on these 20 cases, or we need to wait until 3 matters close before we hire. That's what it means to run the firm instead of letting the caseload run you. As a wise man once said, don't boil the ocean. Meaning, don't take on a bigger task than you can handle. Don't overcomplicate it. Open up your client case management system. Pick your biggest cases. Start there. For each one, do our math. Expected settlement, fee percentage, probability, pre-lit percentage, average time to settle. One simple document is going to tell you more about your future than your P&L ever has. Once you've mastered this, build this into a regular weekly discipline. You know, I feel you. Everyone wants to be in PI because of the, quote, big paydays. But no one understands how hard it is until you've actually been in your shoes. I love contingency firms. There's a lot of great upside, but there's huge complexity and real risk, which is why it's so much fun, because I love a challenge. It can be really empowering to finally see how everything pulls together when you put together a forecast like we've discussed. You'll go from dreading dry spells to forecasting through them. You'll be bolder, you'll be smarter, and you will certainly be calmer. Here at The Lawyer Millionaire, we help law firm owners build profitable practices that pay them so they can transform that profit into capital and transform that capital into freedom. We can help you learn to forecast and master the art of forecasting with precision so that you can build with confidence. Our team of business advisors, CPAs, and certified financial planners is here to help you. You don't need to be a finance expert. You just need a system and a team who gets how your firm makes money. Are you tired of the feast-or-famine roller coaster? Let's talk. Book a call with me. The link is in the show notes. And don't wait, because every case ties up more cash. Get that forecast in place before the next dry spell. By the way, if you're not already following us on YouTube, we're there if you want to see my beautiful face and the faces of those that we interview in, well, not real life, but virtual life. Go like and subscribe to our YouTube channel. Well, that's it for today, friend. And remember just one thing. If your law firm isn't building you wealth and freedom, well, what the hell are you doing? Can I get an amen up in here? Now, go make it happen. And I'll see you next time.
Are you a law firm owner looking to build real wealth and break free from the daily grind? On the Lawyer Millionaire podcast, we share practical strategies to grow your practice, maximize profits, and create the financial freedom you deserve. Join host Darren Wurz as he interviews top experts and successful law firm leaders who share their secrets. Don't just practice law, build a legacy. Listen now to The Lawyer Millionaire wherever you get your podcast. The Lawyer Millionaire podcast is for informational and educational purposes only. It is not intended as legal, tax, or investment advice. Listeners should consult with a qualified professional before making any financial or business decisions. The views expressed by guests are their own and do not necessarily reflect those of Darren Wurz or Lawyer Millionaire Wealth Advisors.